Hello and welcome to today's event hosted by the Student Borrower Protection Center. What does the future of income-driven repayment look like? Thank you for attending. Today's event will be available via recording, and we will send that around sometime later today or on Monday. Now I want to introduce Mike Pierce, the Policy Director at the Student Borrower Protection Center, for opening remarks. Mike?
Thank you, Walt, and welcome to everybody. Thanks for joining us today. This is an exciting time for us to be here talking about the future of the student loan system, talking about the future of the rights and protections that student loan borrowers are entitled to under the law. And I wanted to start by offering a little bit of background about how we got here. Anybody that would decide to spend their Friday afternoon watching a webinar about income-driven repayment probably doesn't need a repeat of the history of income-driven repayment. But to just level set for our discussion today, we are here to talk about what is supposed to be the most powerful anti-poverty program in the Secretary of Education's toolbox. It is a right that borrowers have under federal law to make payments that are affordable and to make progress towards getting out of debt. Congress made a bargain with a generation of student loan borrowers more than a decade ago that everyone would have access to this affordable payment and that student debt would never be a lifelong burden if you couldn't afford it. This builds on a decades-long history of offering tweaks around the margins to the student loan program to try to make payments more affordable, to try to ensure that debt doesn't create a burden in the short term and doesn't hang around forever. And I think a growing body of research, including by our distinguished panelists today, show that this promise has been broken for millions of people. And as a result, income-driven repayment has really failed to deliver, particularly as a way out of debt for people. And so it really is my great pleasure today to welcome our distinguished panelists who are all experts in their own right in how we got here, how this is going for student loan borrowers. And I wanted to also thank everyone who's joined today and everyone who has shared their stories and helped us chart a path forward to reform income-driven repayment. Monday starts a process where the Education Department, for the first time in nearly a decade, is going to be able to write new rules for the student loan system and in particular for income-driven repayment. And guiding those rules should be the voices and the experiences of borrowers that have been trapped in the system and who have been poorly served by the protections that are supposed to offer them a way out. And so I would encourage our panelists to try to keep the conversation focused on the needs of the people that income-driven repayment is supposed to serve, which of course they will. It's why we're all here. And I hope that when the department starts to think about a path forward here in the future, we are really able to keep borrowers' voices at the center of the conversation and make sure that whatever policy approach is established moving forward really fits that frame. So with that, I wanted to introduce our wonderful panelists here. Sarah Saddlemeyer is the Project Director for Education, Opportunity, and Mobility in the Higher Education Initiative at New America. She manages New America's student loan portfolio and engages in work at the intersection of higher education finance and economic mobility. She previously launched and directed the Pew Charitable Trust's Borrower Success Project, an initiative focused on student loan reform, especially to support borrowers at greatest risk for delinquency and default. She also served on Pew's Financial Security and Mobility Project, assessing the relationship between short-term financial security and longer-term economic mobility. Before joining Pew, Saddlemeyer worked at the U.S. Department of Health and Human Services Administration for Children and Families, the Kaiser Family Foundation, the Urban Institute, the California Department of Healthcare Services, and the U.S. Department of Veterans Affairs. Professor Louise Seamster is a sociologist whose research examines contemporary mechanisms for the reproduction of racial and economic inequality. She's currently a non-resident fellow in governance studies at the Brookings Institution, as well as an assistant professor in sociology and criminology and African American studies at the University of Iowa. Dr. Seamster's research centers on politics and urban development, emergency financial management, debt, and the myth of racial progress. Her work on predatory inclusion in student debt has led to extensive policy advocacy, including research informing Senator Elizabeth Warren's student debt forgiveness plan. Jessica Thompson leads the Institute on College Access and Success's work on Pell Grants and other grant aid. education tax benefits, higher education data issues, and simplifying the federal aid application process, and improving tools to help students make wise choices about costs and debt. Before joining TICAS, Jessica spent 6 years as a higher education policy analyst for the University of Washington, focused on national, state, and institutional funding and policy issues. Additionally, she's worked on policy and administrative problems related to energy assistance, homelessness, and mental health. She received her MPA with a focus in public policy from the Robert F. Wagner School of Public Service at NYU, and her BA in psychology from the University of Southern California. And lastly, Persis Yu is a staff attorney at NCLC and is the director of NCLC's Student Loan Borrower Assistance Project. She also works on other consumer advocacy issues. Prior to joining NCLC, Persis was an Equal Justice Fellow at Empire Justice Center in Rochester, New York. Her fellowship project focused on credit reporting issues facing low-income consumers, specifically in the areas of accuracy, housing, and employment. Persis is a graduate of Seattle University School of Law, holds a master's in social work from University of Washington, and a Bachelor of Arts from Mount Holyoke College. And I wanted to introduce Mark Hulsman on our team, who will be our moderator today. He's a Student Loan Justice Fellow at SBPC. He also currently is a Policy Fellow at the Hope Center for College, Community, and Justice at Temple University. Previously, Mark served as Associate Director of Policy and Research at Demos, where he led the organization's policy work on college affordability, student debt, and racial equity in higher education, and contributed to the organization's work on the racial wealth gap and structural democracy reform. With that, I am happy to hand this off to Mark, who's going to moderate our discussion, and thank all of our panelists one more time for joining us today.
Thank you, Mike. And I think that's everyone's cue to come on camera and join the party. I want to reiterate thanks for everyone on Friday for joining us for a panel on IDR of all things. So you all are a really committed audience. We're committed panelists, but kudos to you all. So I have the best job today, which is to lob questions at incredibly thoughtful and smart people who have thought about and been involved in the construction and the of IDR for a long time. So and just listen to smart people. So I'm gonna kick it off with a question that's grounded in some of what Mike was talking about, which is, it's been nearly 30 years since the modern incarnation of income-driven repayment was kind of created and codified, and obviously been adjusted over the years. And it's clear now that for those who are able to access and crucially stay enrolled in IDR, it's clear that it's helpful in preventing defaults or helping borrowers protect against financial shocks. But as Mike talked about, especially any policy, especially one that's been revisited and revised as many times as this one, it's worth taking stock about what's gone right and what's been missed, and where is it failing to live up to the goals that Mike talked about. So we have, a good opportunity here as we embark on negotiated rulemaking, as the department embarks on this process over the next weeks and months. I'd love to hear from our panelists to talk about where you see IDR working currently. Start with a bright spot, and where there are major design questions, trouble spots, and things that we should really dig in on over the next, weeks, months, and years. So any of you can take that first. If none of you want to take it, I will call on one of you and use my moderator prerogative.
Well, I will jump in if no one else wants to start. And first of all, I just want to say, I don't know what all this knocking of IDR is on a Friday afternoon. I don't know what you guys do for fun, but I love income-driven repayment. But to get us started, I think at the National Consumer Law Center, we represent low-income consumers, and so the perspective that I have for the clients that I work with is that it is both vitally important, right? Folks come into my office and they need an affordable pathway out. And for most of them, they're on public assistance. And so they have a $0 income-driven payment plan. And I think that that's a really critically important option for folks to have this pathway where, they're not making payments because they don't have money, and then that still could count, right? That's still in good standing. That's still, benefiting their credit reports. They're building good credit while they're doing this. But the problem is that I can't hold a client file open for 20 or 25 years. And it terrifies me when every single time I close a client file that they're going to have to navigate this system on their own. And and I wish I had data about my client outcomes, like 5-10 years down the road, but I'm very worried about it. And I'm very worried that they're not getting, at the end of the day, reaping the benefits because they're not able to access it. So I think there are many more things to say about it, but I'll let the other folks jump in there.
I'm happy to jump in, Mark. I want to just underscore what Persis just said. I think what's working is for the over 8 million borrowers that are now enrolled, the immediate relief that they can access in terms of a lower monthly payment, including many that have $0 payments, as Persis mentions. That is vital and immediate relief that is very real for millions of borrowers. In terms of what's not working, I think as Persis says, there's a lot to say, but I think that, the IDR payments can still be too high for way too many borrowers. In part because the formula doesn't take into account like key other aspects of family finances, including private student loans that are taken out, medical costs, other lumpy expenses, things that just aren't accounted for in the current calculation. I also think balance growth is a significant problem. So negative amortization and interest capitalization, I know we'll talk about that more today, but I think that the sitting on a ballooning balance, the costs of that for both borrowers psychologically and real, because many borrowers will pay off their debt and receive no forgiveness with an IDR, is a significant problem. And then also you alluded to it, Mark, and Persis as well, in terms of her primary concern, which is barriers to not only getting in, but staying in. So too many borrowers are still having trouble enrolling, and certainly in staying enrolled and making sure that they're able to really see through to the end of the benefits that are promised by this program.
And I think this will probably also come up later in the conversation. So I'll just mention that, pick up on something that Persis said, which is that, a lot of folks who really need this as a critical lifeline are also just engaged with a ton of other things. They're trying to get benefits from the social safety net, right? They were most impacted by the pandemic. They potentially have volatile income, a host of other issues. And so just really the need to think about in reforms going forward, how that IDR and the student loan systems in general intersect with sort of these other kitchen table family finance issues.
I appreciate I come to this from a different place, and so it's really helpful to hear people who are working with directly with borrowers and how IDR works, because I've been looking at this more in a big picture, like taking IDR within the context of the student debt system and trying to compare that to other debt systems to say, like, as a social scientist, if we were just looking at the structure of these programs, what type of debt is it? Is it the type of debt where you expect borrowers to pay their way through it quickly, use it to leverage wealth, or is it the type of debt that is a trap, where people get into debt and they are never going to make their way out of it, and that the profit then comes from along the way in interest and fees and in other payments that people make. And I feel like right now, it's both. It's two systems for two different groups of people. And that's true of a lot of debt systems but I think it's very important to look at it. So important to look at it here. So a Brandeis study a couple years ago showed, probably most people are familiar with this 20 years out from ending school study, where the median Black borrower still owed almost entirely the same amount that they had started with, and the median white borrower had almost completely finished off paying down their loans. And I think that is an indicator both of the racial inequity in the system that I think IDR plays into in various ways I can try and expand on later. But I also think that this shows how IDR works more generally in ways that, like, looking ahead, not just at what people need right now, but like the forgiveness end, I'm very concerned about. And that's why I'm really grateful to be here with Persis Yu today, who's done such important work on this.
That's great. That actually, so all of you touched on what was going to be my second question here. So, IDR, there's, umpteen IDR plans. They all look slightly different. They're different flavors, but they're all, mainly based on the same three common principles, right? And Mike touched on this, that we make federal student loan payments affordable on a monthly basis, right? That we that they're available to those most likely to struggle, and that, you know, there's a guarantee that your federal student loan debt is not going to be a lifetime commitment. You've all touched on this, right? You know, Jessica, you talked about sort of the, you know, questions about whether they are affordable, right? All of you have talked about, you know, the bifurcated system where, you know, there's access for some, and then those who are likely to struggle, you know, may not be getting access. And then we talked a little bit about the debt trap and the lifetime commitment, you know, and Persis touched on that, and we've touched on that in some of our reports at SBPC. So like, those are the three principles, right? How do you all assess IDR in tackling each of those principles? Is there one of them that kind of, you know, jumps out as a red flag that deserves more scrutiny than others? Are we falling down on all of them? You know, where should we be paying our attention given what we know now and have known for the past, you know, couple decades?
I'll jump in there, Mark. For me, one of the things I feel like there's a significant direct tension between 1 and 3 in terms of the principles that you've laid out here. And so because of the way our federal loans are structured and because of the interest rates and a number of other terms and conditions, by providing those lower monthly payments, we are extending the repayment term, and many borrowers are paying more in total because many borrowers will actually pay off in the 20 or 25 years, depending on what plan that they're in. So to me, this in particular, because of what Professor Seamster mentioned about the fact that we actually have sort of, there's not one typical borrower being served in one way within our system, and that we have significant variation underneath in terms of people who are carrying debt that is not on a path to ever pay off. Or pay off much at all, versus folks who maybe are using IDR to smooth out their payments over a sort of typical, you know, trajectory of what we consider an expected career and return on investment of educating themselves. So I think that to me continues to stand out as one of the primary tensions for IDR.
And I would say that, you know, addressing each of the issues is necessary, but not sufficient, right? And they all need to be tackled, sort of building on what Jessica said, in tandem, right? That there is tension between them, and that, you know, I think one of the themes of the student loan system in general is that everything is related, right? Tweaking this thing over here impacts this thing over here. So we really need to be taking this holistic look. And I do think it's important. I know, Mark, you mentioned this and Mike mentioned it at the beginning, but the role of different processes in getting all these things done, right? So some of the changes we want to see can be handled administratively by the Biden administration during normal times. Some have been done and need to be done via Congress, and then some can be handled regulatorily. And, you know, we have a chance to start that process on Monday. So not only thinking about sort of how to handle them, but what is the best vehicle to do it, and can we be pushing on multiple fronts for reform versus what things are sort of a little bit more targeted.
I can add on. I think I completely agree that when you have a program that has multiple goals, that's not automatic that they will all be met together. And so you have to look at the outcomes to see which ones got priority and how they were executed. And I think what we're starting to see is that goal 3 had little to no implementation. And if it was a serious goal, this would be the time that people, if that was a mistake, I would love to see people be like, oh my God, what do we need to fix to solve this problem? And the fact that we're not makes me feel like goal 3, the forgiveness end, the part that's the most important to borrowers, has been kind of seen as extraneous. And the other thing I would say is that those are the explicit goals. As social scientists, we often also look at what goals a system may have that's not stated. Or what function IDR performs if it's not functioning according to at least one of its stated goals. And to me, that's providing a blow-off valve where people can say, we have IDR, therefore we don't have to do all these other things, and it can calm everybody down. The reporters have something to end each article with. Even in articles that are showing the failures of IDR, they will still sometimes have recommendations say, if you're struggling with your loans, you should enroll in IDR. And I do think that enrollment is important, but it's not, these things are not consistent with each other. And I think that it allows people also to compare student debt cancellation as allegedly regressive compared to an IDR system that they are then allowed to claim works without any evidence proving that. And so I think that, sometimes the existence of a program is the point of a program. And I think increasingly, I am concerned by the evidence that is indicating that that is a large part of what IDR is doing, in addition to helping people manage monthly payments, which is important. But I'm very concerned if these two things are not compatible.
Really, I love that last point. And I think that certainly plays out in the media, but I think in the courts too. I'm thinking, how many times do I get the question, like, why is anybody defaulting when income-driven repayment still exists, right? Like, why do I need to think about fixing wage garnishment or any of these other involuntary collection systems when borrowers should just be an income-driven repayment? I don't get it. Like, why are they, what's happening? So I think that's a really important point. And we also see that not just like in this kind of general psyche, but it's been an excuse as to why we don't give bankruptcy relief, right? Like there are a lot of acknowledged problems with the student loan system that people are dumping income-driven payment as the solution for. And so I think that's really, that's such an important point. And yeah, and the fact that like people are not giving forgiveness, not getting the cancellation at the end of the day, I think that's, it's kind of like because of all of the points, right? Like some people are not getting forgiveness because we've made this erroneous assumption that we do a formula based upon income, and your income is a perfect, proxy for affordability. But we also know that there's all the access problems to get into the program too. And so I think they all lead into number 3 as to why are we not seeing the cancellation happening at the end of the day? And I do think, I know we don't all agree on this, but I think the programs have existed long enough that we should be seeing much more robust cancellation, and that we should, as we're thinking about looking forward for how do we do it again, like how do we look backwards? Because I think that's one of the big problems when we've redone the rules every single time, is that, we looked forwards as to like, how can we retool this thing again, but we haven't looked backwards to say like, well, we still have, we have 4.4 million borrowers, who've been in repayment for 20 years. What can we do for them? I hear from borrowers all the time saying, I've been in repayment for 25 years and they just told me about income-driven repayment. You want me to start again and do another 20 years? Like I'm going to be dead. And like, I literally hear people say that over and over and over again. So I think we have to, as we're looking at it, we have to look at all 3 and look backwards.
Actually, stick on that point for a second, because I think you've all touched on something that, it's a couple intersecting problems that we've all identified that, are maybe ripe for reform starting Monday. And that, Persis, you mentioned the 4.4 million borrowers, just to sort of clarify for folks in the audience, that's the number of borrowers who have been paying for more than 20 years. SBPC has a new report out, showing that data. There was originally a request from Senator Warren's office, and that piggybacks off of, Persis, you co-wrote with SBPC and NCLC, an analysis a few months ago that said it was 2 million. So it's actually more than we probably thought, right? We're severely underestimating the number of borrowers out there with quote unquote old debts. And obviously, very few, almost zero, have received cancellation. At the same time, many of these borrowers have experienced the debt trap that comes with negative amortization, exploding balances, interest capitalization. What, to Louise's point and to Persis's point, all of you have sort of touched on this, like, what should we be thinking about, with these old debts, right? It's been, potentially long enough that we can think about what to do about this, whether or not those folks were ever included in the system, whether we should have whether we should have thought about this way before. What do we do about it now with folks who have been paying for 20 or 25 years and have maybe only recently restarted the clock on IDR payments and aren't going to get the benefits of cancellation if they've had all of these other things happen to them, these paper cuts of neg am or interest capitalization? Like, what do we do about those folks?
I have some thoughts as the student debt cancellation person. You could cancel it. You could just cancel the debt. And I'm saying this as somebody who's not had any role in the neg reg process is I'm speaking as like a policy analyst from far away, kind of, but I feel like when we're talking about programs that have been really characterized by administrative burden, so a surprisingly low percentage of people don't recertify an IDR even after the first year. This was something that the SBPC showed a few years ago. And that is really important to me in understanding, like, if you're not certifying the first year and you have 20 to 25 years ahead of you, best case is not good for you. And if people aren't making it through the first year, whether it's on their side or the loan servicer side, we have big problems with administrative burden. And so I feel like solutions ideally will go in a different direction by being simple. So the Department of Education identified 4.4 million borrowers who've been paying for at least 20 years. I feel like you could say that satisfies the structure of, we don't want people to be paying more than 20 or 25 years and cancel their debt, no matter why they still have debt. You could identify all the accumulated interest that people have paid, or and cancel all of that. You could cancel all if we actually knew how much people had repaid towards their debt, we could start factoring that in towards cancellation and saying, like, if you've paid the amount you originally owed, you should be wiped out. And I'm saying this as somebody who's been proposing like universal cancellation of a significant portion of student debt. But I think that I would like us to start thinking about like layering policies of cancellation so that we are like targeting multiple areas where there's big problems. And I think 4.4 million borrowers paying for over 20 years is a huge problem, and that you can administratively just be like, yep, this is that group, and erase it. And that's the opposite of administrative burden. So that's where I stand on this.
I'll jump in there, and I think this population is one of the populations that we agree is of like paramount concern, and I think it's also intersects a little bit with some of the frustrations we've had in the sort of broader conversation around more universal approach to debt cancellation that looks at $10,000 or $50,000, because I am much more interested in making sure that the borrowers that we're talking about here are entirely relieved of their debt. And because of the length of the time in repayment, many of them have balances that, regardless of how much they originally borrowed, that have grown much larger than those numbers we're talking about. And so that's a piece of paper. That's not any real benefit that those borrowers are going to see. And I speak like my 75-year-old mother went back to school with 6 kids as a single parent. She's carrying debt from the early 90s, has been in repayment this entire time. Thank God it has a $0 payment on an IDR now, but will die owing more than she took at. So, I mean, but $10,000, $50,000, that doesn't mean anything to her. It's a piece of paper. So I think that is like this idea of thinking about making sure that we are identifying those populations of borrowers that particularly first and foremost, not saying, but particularly first and foremost, thinking about how do we truly let them walk away from this debt that has not paid off, not for them, and it doesn't pay off for taxpayers to keep them roped in on this.
I think Jessica and Louise both make good points, and especially Persis, I like your point about the sort of the look back period, making sure, it's not the right way to phrase it, but like making sure that whatever sort of reforms we make, we're also retroactive to at least some extent. And so something I've been thinking about a lot is the need to just sort of try our best to eliminate negative amortization. If we can, subsidize unpaid accrued interest, I think that would go a long way going forward, but also has a lot of implications looking back as well, which touches on something Louise was saying about interest. But the other thing I really wanted to bring up was that this is a conversation about IDR, and we're sort of talking about IDR here and people not in IDR. And a lot of the solutions, especially around negotiated rulemaking, have been very IDR specific, right? So eliminating negative amortization for people in IDR, but just really wanting to make sure that we're talking about some of these solutions in a more universal way, that people are accruing interest, it is capitalizing on their loans when they're not in IDR, right? When people are missing payments, when they're in forbearances or deferments, or making partial payments. And so making sure whatever kind of solutions we're thinking about, interest-wise or otherwise, are something that could be more broadly beneficial as well. Because really only like 30-ish% of the portfolio is in IDR. And we want to make sure, a lot of the folks that are struggling the most are not. And so we're wanting to make the program stronger. We're wanting more people to engage in it, but we're also wanting to make sure that we have a robust variety of solutions that sort of provide to catch folks who need it as well. So all of our best ideas are not just going into IDR.
I think that's a fair point, and I want to, not just repick the fight on cancellation, but I can't help it. Sorry. I think there's I think there's multiple debates going on, and I think we have to have them all when we talk about cancellation. I agree that I think we need full cancellation for the folks who've been in repayment for, we've said as, going back to 15 years, right? Like the data that I've seen suggests that there's a point at which people they're not going to pay off their loans. And I don't think there's a lot of benefit in keeping people on their loans beyond that. I think we need to look back and see, right? Like we need to acknowledge all the places where our system has fallen down. I'd love for us to go back and look at, servicers who have a history of steering folks into forbearances and deferments, which I believe is probably all of them. But figuring out like how do we quantify? I'm a lawyer. I like to litigate things. So like, what are the damages of being steered into a forbearance, and how many years of credit can we give, and how many how can we figure out like what's that worth? And the fact that I've seen people in forbearances for decades, like who should not be there. And so like I think in some ways I think of this cancellation as in terms of remedies and damages, that this is what this is about. I think in principle, I'm with you, Jessica, in terms of like I'd love to see the people who need it the most get it. I think in practice that's actually a really large population, and so I think that's why the call for universal cancellation makes a lot more sense, because I think we can't we will clear a lot of debts at $50,000, and I think that there's just so many ways that we've harmed people in the last several decades that we need to do that. And I agree, like going forward we need to get rid of negative amortization. That makes like no sense for almost anybody, and capitalization never made sense to me, but I think we do need to look backwards, and I approach it as these are remedies. Someone bought a busted car, they need to be reimbursed.
It's a lemon. We've got a lemon in our hands.
We got a big lemon here.
I like busted car better. That's great. So I think the question about not just old debts, but like just some of the assumptions behind IDR and whether or not we've whether we're great with our assumptions whenever we design these things, I think runs smack into the conversation around race and student loans. So I'm going to point to Louise on this one first, but obviously you can't talk about student debt broadly without talking about race, right? The particular burden of student debt on Black and brown households. One thing that I'm interested in thinking about, in its intersection with IDR, because IDR focuses on income and doesn't really, it's agnostic on wealth. And the wealth gap, that has particular consequences and choices, right? And one of them seems to be, right, that IDR, we have, one IDR plan, Repay, that has less generous terms for federal borrowers with any graduate school debt, ostensibly because the assumptions are that those with grad school debt, tend to have higher incomes. But we know that one of the major drivers of the student debt crisis is Black graduate school debt, right? That's just one example of where some of our assumptions or blind spots, affect people for decades at a time, right? But I don't have a good answer for how something like IDR pays more attention to, or even just acknowledges accumulated economic and racial injustice. What is the role of loan repayment in a minimum and not making the problem worse, right? I'm going to go to Louise on this because I know you think about this, a lot.
Sure, and I'll probably leave it up to the other three panelists to talk about how to not make it worse, because I can talk about how IDR does make this worse in this case. So I came to student debt trying to understand the growing racial wealth gap, the growth in the racial wealth gap that occurred over the Great Recession. And like we understood some of what was happening with foreclosures, but how did half of Black wealth get lost in 5 years was my starting place. And when we just looked at what was happening with debt, student debt was but the clear outlier. So student debt was going up for every group, but for Black Americans, it was going up much, much faster. A report actually came out today. And if I get the technology to, I'll link to it in the chat or whatever I'm allowed to do, but where we just reran the numbers with the most recent survey data from 2019. And what we'd been concerned about from 2013 has just gotten actually much worse very quickly. And I think it's due to things like interest accumulation, not just more Black households having members attend school, which now 1 in 3 households do carry student debt, but also increasing balances. And I think it's not just that they're getting more education and paying for it more upfront, but that they're less able to pay it down. And so this is just sticking with families now across generations often. And this is because of the racial wealth gap in large part. So there's a great report called Umbrellas Don't Make It Rain, where I think the title really helps articulate the problem, by Derek Hamilton and Sandy Darity, showing that we have this causal relationship kind of reversed, where we say education will lead to wealth, and instead wealth is leading to educational attainment and making it easier to pay off debt when you do take it on. And so we're expecting Black families to compensate for centuries of, including present day racially discriminatory policies, by taking on education debt on themselves, when we're measuring them against prior generations who were able to do the same thing with white wealth. And so what you see is a Black working and middle class that's heavily indebted through things like student debt, without the underlying wealth that makes debt a good bet to leverage and make more wealth out of. And so we have these like assumptions of this like universal financial literacy, like here's what will get you ahead, but it's based on a white model that is again based on like hoarding of resources and policies that were directly advantaging white people to the detriment of Black Americans. And so we're seeing like this present day is a modern day form of redlining, not in terms of the way it's designed, but in terms of a universal government policy that is producing different results and widening the racial wealth gap between white and Black Americans.
Mark, if I could jump in here, a couple of things quickly about repay, or about IDR specifically, in terms of harm reduction here. I think you mentioned the extended repayment term that was added for graduate school debt in repay. That was something that we lobbied pretty heavily against at the time. And I think that, adding at all a repayment period that is based solely on the loan type versus your ability to repay goes against, what the spirit of IDR, was. And it's especially pernicious because it's, $1 of graduate student debt means that your entire loan balance is repaid over 25 years, not just the graduate school debt. So I think obviously, as has been said, that, intersects significantly with race in a number of ways, in addition to the wealth gap, meaning a greater reliance on debt. And this is particularly true, as Professor Seamster said, for Black borrowers. You obviously also see job discrimination systemically impacting the, creating wage gaps, and also pushing for the need to get more credentials and in the first place. And so the reliance on professional and graduate school credentials, the lack of generational wealth, and combined with other systemic, racism over hundreds of years that result in lower earnings and, lots of other issues that intersect with that. So I think that is one very clear thing that should be done away with in IDR. I think I'm a little bit concerned about attempts to account for wealth in IDR. I think Sarah could speak a lot more to this, but the experience in other federal social safety net programs makes me worry. The complexity, it's potentially rife with unintended consequences. But getting back to doing a better job at identifying the borrowers who are persistently struggling in IDR, who entered college with high financial need and or are persistently struggling with low low incomes and repaying their debt after college, and figuring out how we provide more robust assistance, forgiveness along the way, ending neg am, and all the things that we've talked about. But before I stop, I want to briefly say too, I think there's other context that's also really important here, because I know we're not talking about this today, but in our work, we're looking at increasing, educational attainment and reducing, equity gaps in educational attainment. And so thinking about access and success and thinking about, addressing these problems, it's really important that we contextualize IDR as one piece of a comprehensive financing system and college costs and debt. And so I think, thinking about need-based granted, thinking about state disinvestment, thinking about college costs, these are areas where we have put a lot of our effort in terms of systemically reforming the financing system that we have defaulted into after decades of policy choices. And so while I think, in some ways I worry that IDR, which I will say from early on was more designed as a safety net, for some borrowers who would need, who couldn't make that monthly payment and would end up in default with terrible consequences. And it now to look at it as the central policy mechanism through which we should try to address college costs and debt, I think is highly problematic. And not only does it have unintended consequences in ways that Professor Seamster has talked about, it also has unintended consequences in terms of costs and to begin with. So I think that is another piece where I just think it's important to keep in mind that IDR is one piece of a much wider system.
Yeah, I mean, I will underscore a lot of what Jessica and Louise said. I'll also say that, representation matters, right? Like, we're having a conversation about the racial wealth gap. We all have worked on, various pieces of this for a long time. Policymakers have been working on this, in various iterations, but that, like, we really need to make sure that folks with lived experience to that effect are also at the table in the policymaking process in terms of NEGREG. And, on the Hill, sort of in these conversations as well.
Oh, sorry. Yeah. I think that a couple really important points, and one of the things I wanted to kind of tie together is, what Jessica was saying about like IDR in context, and then bringing that back to what we talked about before, right? Which Louise mentioned before of, we can't, like, IDR can't be the excuse that we don't fix everything else. We can't, absolutely, we need to move towards a debt-free college system, and like, the IDR can't be the solution. I mean, it's also not the solution, the rebuttal to cancellation, which we've also discussed, that like, it does not solve the world's ills. But I mean, I think as we're looking forward, and I think we just have to come up with principles, like how long, like, what do we think is too long to be in repayment? What do we think is too much to pay? And then we have to stick to it. And, like, the tinkering that we do of, oh, well, let's tier it for graduate versus undergraduate, or people who've paid, this balance or something else. I think we need to have principles of what we want repayment to look like, and then stick to them.
I love that. And as someone who has gotten substantially more gray hair on their head, thinking about the sort of front end debt-free college side of things, I couldn't agree more that, this is one piece of a much more systemic problem. And Jessica, actually, I think the points you made about IDR, what the intentions were about, who it should serve, and then relying on it as the central mechanism. I mean, I think that's true of the loan program broadly, right? Like what the point, like moving to a debt finance system of higher education was done, that is a series of choices, but we should go back to what the principles were of things like the Pell Grant or need-based aid or state investment in higher education to realize that we've sort of gone far afield and relied on tools that weren't meant to be the primary tools. Actually, I think the next question, this might be the last question before we sort of wrap up and think about audience questions. So please feel free to put some in the chat. I've seen, or the Q&A function, I've seen a few that we'll try to get to. I think, Jessica, you put this well, the next piece that I want to talk about well, which is like this discussion of, for lack of a better term, trade-offs. A common theme throughout whenever we sort of relitigate or redo IDR is that, we're sort of start with a series of trade-offs, that rather than starting necessarily with the principles, as Persis mentioned, whether that's affordability or making it time limited or helping those, most borrowers who struggle no matter what, it seems like we start with these questions of like cost, or first starting with ensuring that there aren't people quote unquote gaming the system, whatever folks often mean by that, rather than starting with principles. I want to actually ask if that's my sense of this, but I want to ask if you all share that approach, and as we approach sort of NEGREG, how we break that cycle, right, of starting with the let's make sure we're not having those game the system, and we actually are getting our arms around those most likely to struggle. Does that question make sense?
I think so. And I think, some of the thing, when I think about the complexity of the system and how we got here, I think one of the things that has caused a lot of the problems is we have done it in such a way that is meant to be, to cost as little as possible. And we've done it kind of explicitly at the expense of people, right? So you think about like public service loan forgiveness and all the failures, and it's like because they made it really complicated, and I think they kind of did that on purpose, right? Like they didn't include FEL borrowers, not because no one thought about FEL borrowers, because that was really expensive. And now they also knew that they didn't have to suffer the consequences for another 10 years. And so now we are paying the price for that exclusion, right? Think about how we structured repay, where you had to have had a loan after, like this really complicated tooling about like who was eligible. And these are all based upon budgets, right? Like those were the guiding principles. And I think a lot of the like knots that we've twisted ourselves into on why people are not getting things have been because of really bad choices we've made for budgetary purposes. And so I think that that's one of the things where we have to try to resist that at all costs.
I agree. And I think there's plenty of times when we are not talking about these same concerns, like people who are using tax loopholes and fraud at the, at the highest level. That would be actually, it would help budgets because it would return like tax dollars in the billions and hundreds of billions that are supposed to be like in the federal government coffer. And yet we don't pursue it because we actually only target these like strict like fraud prevention policies towards programs that are designed about poor and working class people. And fundamentally ideas about who's deserving of what and where we put administrative burden in programs that make it not worth the while. And I think that the data showing of how few people are getting forgiveness at the other end is all the data you need about administrative burden to show that these programs are not working. I think also, Persis, your comment about like you can't keep a file open for 20 years, like that shows a fundamental problem with the way this is structured, that we're like, I've been thinking of it as like we're sending people out into shuttles to space for 20 to 25 years saying, oh shoot, none of these shuttles are calibrated to come back home again. Let's keep sending more people out that way. Like generationally, we don't have the ability to keep the focus on like whether that outcome panned out that was supposed to happen 20 to 25 years ago, like to like have that follow through. And I think that the length of time, the conditions, the eligibility recertification, all these things together have created a program that is of the type that we design for programs where we care more about like the fear that people could get higher education for free. And that's the gaming the system that we're concerned about, is that, like, I think it shows that our values are wrong. Our values should be like higher education should be free, and that like period, and not be accusing people of like committing a crime to get it. And also that like what Persis said, like how long should people have to repay? How much of their loan should they have to repay before we think it's enough? Like if we've configured it, we have to get away from that language of like terms and eligibility in order to make, or else we will not like substantially change the outcomes that we're seeing now.
And this also sort of underscores the point that we've been talking about throughout, which is that we do have to talk about the system holistically, right? Like through negotiated rulemaking and on the Hill and elsewhere, like people will talk about the individual terms and try to hammer those out, but that the beginning of our discussion shouldn't be one with a scarcity mindset, right? Like we should be thinking about how do you put all these pieces together? And then once we sort of have our goal, we're sort of agreed upon goals, we can go in and sort of adjust the different pieces, but that, I don't even have off the top of my mind, like a specific number that would make sense in terms of like the different pieces of the program. For me, I care a lot more about the end package kind of addressing some of the holistic goals that we've talked about here.
I just want to add to that really briefly, because I think Persis and in particular makes a lot of really good points, and I agree and wholeheartedly that simple, understandable principles that reflect what we think would a program that would achieve the goals that we're trying to achieve are really, really important here. But I do also think it can get complicated very fast, and it's not that easy to say that what should be is something we can force, because the reality is that at the end of the day there are constraints, and we are going to end up also having to engage in harm reduction when we see the fact that through negotiation and through stakeholders with power to make decisions legitimately have different values, and that is going to affect and manifest in both a rulemaking as well as, of course, in Congress in a different way. And so I think that's also a really difficult one to grapple with as well, is always having to make that decision is, am I doing more harm than good by sort of, again, like I think the word you used, Persis, or the phrase was like, twisting ourselves into pretzels. And I think that's a lot of times where that stuff comes out of. It's like there's something that we see that is not that is harmful, and we can't move it off. And so we try to come up with something that meets the needs of whatever is pushing it. And what are the end results better? Are they worse? It's really hard to say. But I just want to acknowledge that I think that it is more complex than we like to talk about. And I think that it is, it is a difficult process, and one that has a lot of stakeholders across a value structure, and they're all part of it.
I mean, I think, and I will acknowledge that I think I was the one who may have first said the words simple, but that we haven't actually talked a ton about implementation, which is obviously a huge role in this too. And I like when we talk about how IDR should work, I actually prefer using the word easy rather than simple, because I think a thing can be easy to use even if you don't actually understand all of the working pieces of it. And I am not, if we can come up with a system that gets like borrowers affordable payments, I'm not as worried about like all of the like intricate ins and outs being, understandable by every single borrower. If the process of getting them from point A to B can be easier, and we have servicers who we pay a lot of money to can get the borrowers from point A to B. So I think, like the implementation is also like a really critical component of that. And we have not spent as much time on that today.
That's right. And I think, in part because, we're thinking about this in the context of neg reg, right? And actually, designing, or correcting some of the policy design mistakes as we've talked about today. But that point is, I think a perfect point to kind of end on here, that there's a holding feet to the fire piece of this, from servicers clearly, and those implementing the whatever comes out of the next phase of IDR, but also policymakers, right? That we're consistently telling the story about implementation and where things have gone astray to policymakers who are charged with making the system work better for students. So we are at wrap up time. I want to thank everyone for joining us today that took their lunch hour or took a lunch hour early or whatever to talk about IDR. Persis' point is well taken that maybe this is what a fun Friday looks like for most of you. But I think the point of this discussion and having it, the impetus behind it, was that the stakes are really high here. That this went from a policy, to Jessica's point before, that was thought of as a safety valve, to something that the terms of which affect up to 10 million people's lives, right? And in a growing amount of people's lives. And, it's time to think about those lives and, what we have done or not done to ensure their financial stability as we embark on this next round of policymaking. So I'll reiterate Sarah's point that prioritizing and lifting up the lived experience and voice of borrowers in this discussion, it sounds obvious, but I don't think we can hammer home that point enough. I thank you all for all that you do on that. That we don't assume, based on a piece of paper or a spreadsheet that an affordable payment is actually affordable without some deep reflection in the communities who have most been impacted by our policy choices or just inertia, right? So I'm looking forward to this. Upcoming NEGREG. I thank you all for what you have done to contribute to this really robust discussion. A point of privilege as a fellow at SBPC, I encourage folks to go to protectborrowers.org and check out the recent SBPC series on IDR. Both there's documents around the history and principles. There's a paper on affordable monthly payments and whether or not IDR is driving affordability. There is a paper that I wrote on runaway debt and negative amortization and interest capitalization. There's stuff on administrative burden and alt doc, and then we have a new paper on what to do about old debts. So take the weekend to read all of those before NEGREG if you'd like. But again, I want to thank everyone for joining us today.